Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Nasdaq Felix Options trading floor is Shawn Cruz with TD Ameritrade. We're in the second hour of trade, still in the green, a little bit off the highs, with the Dow and S&P 500 sitting at new all-time highs. The Dow is up 8 straight sessions. Shawn, it's been quite a market to watch. So what are you looking at for going into the second hour?
There's a little bit of a divergence in performance right now between, you'd say, the tech-heavy Nasdaq, which I think is getting a little weakness from the chip makers, especially after the news we got from Micron. We are seeing some of the other indices able to hang high. But I think right now, if you're looking at the VIX, it's down just a little bit. And I think the VIX is going to be what you want to watch if you want to get an idea of what the market's going to do going into the close today. If it continues to pull back, then I think that can be something that can rally stocks. But if you do start to see the VIX decline, then I would actually expect most of the indices to just pull back broadly going into the close today. So that's what I'll be watching the rest of the day.
Well, you know, it's really interesting timing because here we are at the 10-year anniversary, almost to the day, right, of the beginning of the financial crisis, right? And now we're sitting at all-time highs in the market. I just remember being there in the thick of it in 2008 and 2009. Who would have thought that we would be where we are right now with just a significant run to the upside?
And it's almost right now is an interesting time to be watching markets and to be a trader, because a lot of what was done to address the crisis is starting to get undone a little bit when you talk about what central banks did. So they really solved the crisis as being a lack of liquidity in the economy. So really what they did was just massive liquidity injections. And it wasn't just the Fed here in the U.S., it was central banks around the world. The Fed started tightening a couple years back. We're starting to see some other central banks either discuss having a little bit more of a tighter policy on the horizon, or have taken intermittent steps to maybe not be as accommodative. So I think if you're a trader, for the past couple of years, you've been trading in a world just awash with liquidity. You need to make sure you're paying a little bit more attention to liquidity moving forward, because it's been a nice little backstop we've had in the past few years that may not be there moving forward.
Well, I mean, think about it. You have an entire generation of traders who have never traded through a significant volatile time. I mean, we had a couple of blips here or there with Brexit, with Trump winning the national election, and a few other events. There was some volatility, I would say, what was it, beginning of January, February 2016, but there wasn't a prolonged period of volatility. But even leading up into the financial crisis, this is a question that we ask a lot. There were certain events that led us there, right? There was a number of risky products and assets that, mom and pop retail traders were trading, and banks were over-levered. And we know all of the risky things that were taking place in the market. Would you say that as a whole, as a financial industry, have investors learned anything from this?
I think we've seen a lot done on the regulatory front in terms of making sure banks are well capitalized. We've got stress tests out there now. So there really is more of a focus on risk management than I think there was prior to the crisis. And I think there's also more an awareness of what an over-levered economy or what high amounts of leverage can do. And just like I think the biggest change was for the bigger banks, if you're a regular investor, there's still lessons to be learned from that, because you still can use leverage in your portfolios. You still need to make sure you're taking appropriate steps to manage risk and be aware of risk. So I think there's a connection there that was really geared towards the banks, but everyday investors can take some lessons from as well.
And I think being in the financial industry, that's something that we need to communicate to investors. There's no reason to own 2 homes and spec houses if you're making $50,000 a year. There's no reason to get into really risky levered ETFs, for example, if you're not diversifying your portfolio. I'm really hoping that investors understood that lesson. There's so much education that's out there right now. There's really no excuse not to understand that. I mean, look at all the education materials on your platform alone. There really is no excuse. There are so many outlets out there that can help investors not fall into that trap that we saw 10 years ago, because it really was quite devastating for a lot of people.
And we make sure TD Ameritrade clients always have free access to what I think is industry-leading education. And right now, today, with the rebalance, with the new sector getting spun out, is another opportunity for investors to make sure they are managing the risk. They're going out there after this rebalance with the new sector being added to make sure you are okay with your allocation in your portfolio, because you are probably going to have to make some shifts, particularly out of your tech and your consumer discretionary holdings, to make sure you're still in balance.
Right. Well, another topic that we debate as well is the past a prelude to the future. Could we possibly see another financial crisis? You know, the bull market is going into 10 years old? Is it prolonged? My question is, do we have to go through this again? Does there necessarily have to be on the same cycle that we've seen historically? This market right now is very different than what we saw in the late 90s with the dot-com boom, right? It is very different than what we saw in 2008 and 2009. It's the market structure is completely different.
Yes.
The basket of stocks leading the way. Our economy is completely different from, let's say, hardware to consumer services, right? And then we're going to see that at the close, as you were saying. Perhaps we've learned something from this. Why do we have to go through it again, considering where we are now?
I think it's interesting to see a lot of economists or just market watchers out there start talking about traditional bubbles in the sense that we saw last time. Because typically these crises don't repeat themselves. And if you're looking out for it, then that's probably not where it's going to come from. These crises usually come from maybe a little bit more of an unforeseen,
like an
risky
outlier.
area, an outlier that you really don't see coming. And that's why they create these crises, is no one's really prepared to handle them. But if you're an investor, the best thing you can do to make sure you're prepared for a crisis is just make sure you have standard risk management principles in your portfolio. The first step on that path is being diversified.
You know, and it's interesting that you bring it up that it could potentially be the outliers. Perhaps that's why regulators are taking their time and trying to look at all the different facets when it comes to digital assets, for example, right? And why we don't have ETFs with crypto as the underlying, and as we are trying to figure out how all these components work, how it can be regulated, where does custodian come into play, all of those metrics, whereas if we just kind of let it pass and have it fit in the equity market structure model, that could have potentially been the outlier. And I think that's something to recognize as we try to avoid risky assets that we saw in 2008 and then the dot-com bubble, with everyone, taking cash advances from their credit cards to go buy shares of stock.
Yeah, I think due diligence is key right now, and especially when you have some newer sectors or some newer assets coming out there. You talk about crypto as one, but you need to make sure you have a very sound understanding of whatever you're putting your money to work in. And to the extent that you do start to see some of these newer technologies get put into some sort of securitized product that you can invest in, you really need to make sure you're doing your due diligence and understand what you're putting your money into.
All right. Well, thank you very much. We'll catch up again at the 11:30 hour. And thanks for spending the day with us. I'm Jill Malandrino, Global Markets Reporter.